Well, welcome everyone to Ignition Law's General Counsel Know-How series and to today's webinar on a guide to growth shares and share options being run by John McLean and Lauren Long. John and Lauren will be covering a lot of ground today as we jump into the world of equity investment schemes, the tax implications of them, and some pitfalls to
Hello, how are
avoid.
you?
Our speaker today, John McLean, is a senior consultant with Ignition and is a specialist when it comes to corporate tax. John has worked both in private practice and in-house. Lauren Long is a corporate lawyer with us here, working closely with early stage companies, supporting them with investment rounds, M&A, and setting up EMI schemes. I'll hand you over to both John and Lauren.
Thanks, Toby. I appreciate the intro. As Toby mentioned, I'm on the one of the managing associates at Ignition, focus on helping early stage and scale up companies on the corporate team, and more recently advising on equity incentives and share options, which we're going to dive into today.
Thanks, Lauren. Yes, I'm John McLean. As Toby said, I'm a tax specialist, focusing primarily on corporate tax. I've done a lot of work with Ignition's early stage clients, helping to set up these sort of share option and equity incentive schemes over the last few years, and happy to be with you today. Before we dive in, if anyone has any questions on the way through, please just raise your hand or jump in. We're keen to keep it as interactive as possible, so please feel free. Lauren, do you want to lead off?
Yeah, of course. I've got the slides up on my screen, so I might not see everyone's hands go up, but yeah, do feel free, use the hand up function or put your questions in the chat and we'll get to them, and we'll also leave some time at the end for questions too, but please do jump in if you have them. So what we're going to cover today, we're going to run through an overview of equity incentive schemes for employees. These are the HMRC tax advantage schemes. There are 4 in particular, but the main ones that we're going to focus on are enterprise management incentive schemes, or EMI schemes, because they tend to be the most appropriate for the companies that we advise at Ignition and the stage in the company growth cycle that our clients are at. We'll be talking about the tax implications, tax benefits, and qualifying criteria for EMI schemes, having a think around some alternative solutions, which will include growth shares that John will talk about. These we're seeing increasingly popular with some of our clients as a way to incentivize individuals the individuals who either don't qualify for EMI or where the company doesn't qualify for EMI. And some pitfalls and some hints and tips on where companies have tripped up in the past in relation to EMI schemes and growth shares. So if you do decide to go down these paths and implement these share options or equity structures, learn from others' mistakes and don't make them, because there are quite a few pitfalls. So I thought it would be a useful starting point to just talk briefly about what share options are, and forgive me if you know this already, but I think it's helpful just to set this out. So share options are contractual rights to acquire shares in the future at a fixed price, also known as the exercise price. Important thing to bear in mind is that option holders are not shareholders. So they have no shareholder rights from day one when they're granted the option. They basically just have a right to acquire shares in the future if a certain event happens to the company, or if they stay with the company long enough, if those options vest and the trigger event happens. They're very useful to recruit talent, retain talent, but also to reward and incentivize performance. And companies will do that through the vesting provisions in option agreements. So you might say you acquire the right to a certain number of shares if you stay with the company for a certain period of time. We often see around 3 to 4 years, or it might be that you want to incentivize an individual to achieve certain KPIs or certain targets. And so you might have performance-based rights to acquire the shares. Even though they only have a contractual right to get shares in the future, it does give employees and individuals are feeling that they have a bit more skin in the game and a sort of quasi ownership right in the company, even though practically speaking, since they're not shareholders, they don't have a right to dividends or capital or anything like that until they exercise the options. Briefly, even though we're going to spend the rest of the talk talking about equity incentives, it is worth, if you're thinking about different ways to incentivize your employees and advisors, interrogating whether equity incentives are the right thing for your company. So there will be alternatives that you could use, such as exit bonuses if there's a sale of the company. Would a commission scheme be better if you're trying to incentivize a sales team? As a founder, do you want to try and hold on to equity? And if your cash flow is quite good, could you just pay higher salaries to retain talent? And if you do want to put in place a share option scheme and have a share option pool, would that be for all the employees, or do you want to just reserve it for the senior management team? So you have a small number of grants and it's perhaps a bit more easy to manage. But as we're going to talk about, EMI options in particular have many, many tax advantages, which make them particularly attractive if the company and the individuals do qualify for them. And I mean, in addition to that, it also allows or enables companies to recruit and retain talent while offering potentially lower salaries, which eases any pressure on cash flow and incentivizes those individuals to work hard for the success of the company. So I mentioned at the start.
Sorry, do you want to take this slide? You happy? Carry on.
I'll go for this one. Please do feel free to jump in, because I'm not a CSOP, save as you earn or SIP specialist. But as we mentioned at the start, there are 4 different types of HMRC tax advantaged share option plans that companies can take advantage of. The CSOP is all of these are share option plans for employees, we should say at the outset. If you're looking to incentivize advisors, consultants, the tax advantages, well, you don't really get them unless you implement a growth share structure or something like that. So a company share option plan is generally for companies that are a bit larger and no longer qualify for EMI. So it's something to look into if you don't qualify for the EMI scheme, and we'll go on to the qualifying criteria for that in a minute. Save as you earn, also available to certain employees in the UK who qualify for it, and the options are conditional on the employee taking out a linked savings account, which is why it's called Save as you earn, with a bank or building society, and then they use those savings to pay for the exercise price for the shares when they come to exercise the option. Share incentive plans have to apply to all employees within an organization. So there's no scope to only incentivize, for example, the senior management, like we mentioned, which is possible under EMI schemes. You can pick and choose, subject to employment law and being able to do that. But share incentive plans, within this, the shares are held by an employee benefit trust. So it's a slightly more complex structure to implement at the outset, but there is some flexibility to grant different types of options where the options might be paid out of, if you have existing shares, new shares could be acquired from the dividends from the existing shares that you have, or shares can be acquired out of the pre-tax salary of the employees. There's a few different ways that you can do it. But what we're going to focus on...
The limits on those are relatively low, though, just to be... We're going to spend most of the time on this presentation talking about EMI, which is the most generous in a number of ways, including the size of grant that can be made to any one individual. Share incentive plans are really intended to incentivize a large pool of perhaps not terribly well-paid employees. It's a kind of the sort of thing that you might see in a large supermarket chain, for example, as an offer to employees to be able to participate in the equity of the supermarket. To put a number to that, so the employees are entitled to acquire up to £1,800 worth of shares per year, or 10% of their income if lower. That's for their tax, the payments out of their pre-tax income. And the employer is allowed to give shares of up to £3,600 of value to each employee. So they're relatively low numbers, but can be quite attractive where there's a large pool of employees that you want to incentivize. Sorry, Lauren, just wanted to add a bit of color.
Good context. So yeah, share incentive plans are at one end of the scale of a company's sort of growth cycle and size. Enterprise management incentive schemes are at that other end, and it's designed for earlier stage scale up businesses to incentivize their staff. And the limit for what you can grant to an individual, John's going to talk about, is it £250,000?
At any one time, yes, any individual can hold options over shares worth up to 250,000. So it's significant compared to some of these other schemes.
Significantly higher. And there's a number of qualifying criteria, but if the individuals don't qualify, then you can always think about awarding non-tax advantaged options or unapproved options. They look more or less the same, but they don't come with all the tax benefits.
Yeah, maybe worth just I guess framing this around what the tax treatment is of unapproved options, so that we can kind of contrast that against the tax treatment for CSOP and EMI in particular. An unapproved share option, a share option generally is not taxed when it's granted. There are essentially four things that happen with a share option. It's granted, it may have vesting conditions that cause it to vest, it's exercised, and then the share that is acquired is ultimately held. So those are the four stages of the life cycle of an option. When I say vesting, the employee is entrenched with the option to the point that if they were to leave the company as a good leaver, then the option wouldn't be taken away from them. They'd still have the right to acquire the shares. It doesn't necessarily mean they can acquire the shares today. It means that the option is matured. They've met the condition for length of tenure with the company in order for the options to vest, and often that happens over a period of time. In terms of tax, the grant and the vesting are a nothing from a tax perspective. The tax authority doesn't really care. They have to be reported, but there's no tax, no income tax that arises, no national insurance that arises on the grant or vesting of options. When an unapproved share option is exercised, though, what happens is the company says, okay, you've got a right to acquire 1,000 shares for £1 each. These shares are now worth £10 each. So you're getting £10,000 worth of shares. You're paying £1,000 for them. You have £9,000 of income, and you owe us income tax on that. And in some circumstances, I don't know, we need to go into the detail on this, but in some circumstances, there's also national insurance to be paid on that as well. So that can be pretty expensive. I mean, top rate of income tax, 45%, potentially plus national insurance on top. That can become quite an expensive exercise. And importantly, the options may be exercised at a time when no cash is coming to the employee. They've got the right to acquire their shares. The options are vested. They decide they want to exercise. And they get the shares in their hand, but they're treated as, in my example, they're treated as having received £9,000 of income, but they haven't got any cash to pay the income tax. So it can be pretty problematic, this sort of dry tax charge. And the way that these tax advantage option schemes, again, focusing on EMI here, CSOP works in largely the same way, is you kind of rewind the clock. When the option is exercised, instead of taking the value of the share at that date, you go back to when the option was granted. And generally speaking, you set a valuation at the time the option is granted. EMIs, in the case of EMI, you actually agree it with HMRC. You say these shares are worth £1 each. You grant options to acquire the shares for £1 each. And when the option is exercised, provided the EMI conditions have been respected, HMRC will say, well, the value of the income is £1 a share, regardless of whether the shares are worth £10 or £100 or £1,000 at that time. And so the employee can receive the shares with no income tax, no national insurance. There's no national insurance exposure for the employer. And then all of that increase in value is effectively pushed into the capital gain that the employee hopefully receives when they come to sell the shares at some point in the future. Maybe pause there. Any questions on this? I think that's critical to the whole discussion around EMI. No hands raised. We can perhaps continue to the next slide. Okay.
So we thought it'd be useful to just put in some stats.
Yeah, always good to have some stats. This is really just, again, to frame the extent of the tax benefits that are available in respect to these options. We'll come to the qualifying conditions in a moment. But again, I don't want to read from the slide, but you can see there are some pretty significant numbers there of taxes that have been saved, both income tax and national insurance. That's combined employer and employee national insurance from tax-advantaged employee share schemes. The most generous scheme is EMI. The largest the largest contributor to tax relief is EMI. But we'll come to the next slide, which actually save as you earn is a more significant value driver in terms of the total number of options granted. I think that just reflects the fact that EMI tends to be granted. It's granted by a lot of companies, but they tend to be earlier in their life cycle. They're actually restricted in terms of the size of the company that can issue them. Whereas the save as you earn schemes, the individual grants are very small, but there are a huge number of participants because they're by definition they're offered to all employees. They tend to be offered by larger employers. So even though the number of companies offering them is smaller, the number of participants is huge. So this slide shows that quite helpfully. You see EMI there in third place in terms of total size by value of the options granted. That's the value of the shares over which options are granted. But in terms of the relievable gain, so essentially the capital gain benefit and then the income tax and national insurance relief, you'll see it's easily the front runner in both of those, despite the fact it's the smallest, is a smaller participant in terms of the total number of shares over which options are granted. And then here again, to illustrate that point, EMI by far and away the most popular, if you like, in terms of the number of companies participating in these schemes. 4,500 companies participating in this space of tax year 2023 compared to a few hundred for each of the other schemes. It really just reflects the scale, the relative scale of these schemes. All right, I've touched on this already, so I don't know that we should spend too much time on this slide, but again, the grant investing is not a taxable event. The exercise of EMI options, we look at the value of the shares at the time the option was granted. So as long as the exercise price, go back to my simple example, if the value of the share at the time the option is granted is £1 and the exercise price is set at £1, which is pretty standard. You can set it higher or lower if you like, but it's pretty standard to set it at the market value of the shares at the time of grant. Then there should be no income tax and no national insurance at the time of exercise. Things can happen though between grant and exercise that cause that to change. I mean, the first thing is, again, if you issue the shares at an exercise price below market value at that time, then you've got a small slug of income there. More significantly, and perhaps something that might not be expected at the time of grant, you can have a disqualifying event. What that means, the company or the employee ceases to qualify for the benefits of EMI. We'll come on to the qualifying criteria in a moment. But you need to be quite careful about these because potentially a disqualified option results in reversion to that unapproved option status. And you can find employees with a significant unexpected tax impact from that income tax impact. And then on the sale of shares, well, what happens? You've acquired your shares for £1. They happen to be worth £10 or £20 or whatever they were worth at the time they were acquired. You sell them later for £30 a share. All of that increase in value from the £1 you paid to the £30 you receive when the company's sold, all of that is treated as capital gain. There's no national insurance payable on that, and the rates on capital gains tax are significantly lower than for ordinary income. The Chancellor, it's a kind of a long previewed expected rise in capital gains tax. This was announced in October. The rates have been very much lower than income tax. They haven't been aligned completely with income tax, but they are coming up. So that tax benefit is being eroded somewhat. Capital gains tax, if you were to sell shares acquired from an EMI option today, you pay as little as 10% tax. That's going to rise to 14% from April 2025 to 18% from April 2026. So it's ticking up.
Thanks, John. I think I saw a couple of questions in the chat, but they've now disappeared off my screen.
I can see, hang on, I can see them here. From Anthony, do the split between EMI for private companies versus public companies, or is it all for private companies? Good question. There's a very significant restriction on the company in terms of its ability to grant EMI, and that is that the company must not have gross assets of more than £30 million, 30, which I think would knock out almost every public company. I don't think there are many that will be listed. Maybe on AIM there might be some that are smaller than that, but it's almost universally a private company scheme. I don't think we see these in public companies at all. Having said that, you see them issued by private companies that later go public, and you'll often find that these options are exit only. And one of the things, exit only meaning you can only exercise them and sell the shares, and you're in fact often compelled to sell the shares as part of an exit. Exit being a sale to a third party, a sale of a significant majority interest to a third party, or a listing. So you'll often find EMI options being exercised as a company makes that transition from private to public. When I say public here, we're talking about listed as opposed to, you could be a public limited company without being listed, I guess. But if we take that as a listed company, then that's when you tend to see the intersection of EMI with public companies. So thanks for that question. Qualifying criteria. So we've touched on the gross assets limit here. This is tested at the time of grant. So as soon as your gross asset, and gross assets is really tested, it's really an accountancy measure. It's tested on effectively the balance sheet value of the assets, the top part of the balance sheet, ignoring any liabilities. And that must not be more than 30 million. That includes obviously any equity that's been received. So a company reaching that stage where it takes a large equity round that tips it over 30 million pounds of gross assets as that cash comes in, can find itself in a position where, yesterday it was allowed to issue EMI options, today it's not, but that doesn't invalidate the EMI options that have already been granted. That's not a disqualifying event, it just prevents the grant of future options. Similarly, when granted, the company mustn't employ more than 250 people. There's a limit on the total number of EMI share options it's pretty generous, right? We're talking about companies with gross assets of not more than 30 million. So I guess you assume from that the company's market cap or valuation would be less than 30 million. Not necessarily, because it could have intellectual property, for example, that doesn't count towards that asset total. But regardless, you may issue up to EMI options over shares worth up to £3 million at any one time. And that is tested again at the time of grant. So it's each option, if the shares are worth £1 today and you issue, I don't know, 1 million options to a bunch of employees today, but then tomorrow they're worth £3 a share, that doesn't mean that you need to kind of backdate that and look at the existing options and revalue them up. There is a restriction also on the kind of activities that can be done. So generally, most kind of ordinary commercial businesses will qualify to issue EMI options. The types of activities that are excluded are financial services, businesses that are generally involved in land management or extraction of natural resources, professional services companies. Those are kind of the three main categories. There's a bit of nuance there, but farming and forestry and these sort of things fall into that land management head. Excuse me. And then the last one, I've kind of taken these out of order, but the last one at the top there in terms of the company, it has to be independent. You cannot issue EMI options if out of a company that is 51% owned by another company. You can issue them out of the top co. If you've got employees in this company that's a subsidiary, you can issue options to employees of the subsidiary from the top co. If it's independent, it's not controlled by another company, but the subsidiary, anything that's a 51% subsidiary, is not permitted to issue EMI options. And that potentially is a disqualifying event. So a company that's independent today that then has an investor come in as a 51% corporate shareholder tomorrow disqualifies the existing EMI options. And we can come to what that means when we talk a bit more about disqualifying events, but that's an important distinction here. Of these restrictions, that's the one that sometimes trips people up after the fact.
Yeah.
And then in terms of sorry, Lauren.
No, I was going to say we'll be talking about that when we get to the pitfalls.
Yeah. I don't want to spoil the surprise for later, but a bit of a preview is not fun. Option holders, the options can only be granted to people who are employees, meaning they say full-time employee or director. Full-time is kind of fairly generously defined here. It says you've got to work for at least 25 hours a week for the company or for companies in the group, right? It doesn't necessarily need to be that company. It can be a subsidiary or a sister company. Or if you don't work 25 hours a week, then 75% of your working time. So somebody could be a part-time employee only working 10 hours a week, as long as they're not working for someone else. So that their 10 hours is less than 75% of their total working time, they can still qualify. EMI options are intended for employees, not for founders. So that the way that's crudely defined here is it's not, you can't grant them to someone who holds or as a result of exercising the options would hold more than 30% of the equity of the company. And then there's the monetary restriction, which is to say that at any one time, an employee must not hold options over more than £250,000 worth of shares. Again, valued at the date of grant, not at the date of potential future grant. So you can be granted options over £100,000 worth of shares today. Next year, the company might have tripled in value. Those shares are worth 300k, but as far as this restriction is concerned, we're only looking at the 100,000 at the time of initial grant.
So quite a few hurdles to jump through.
Quite a few hurdles. Look, it's a very tax favored scheme that defer or the effectively backdating of the valuation to the point of grant is potentially incredibly valuable. HMRC wants to make sure that it's targeted, right? It's intended to incentivize employees of growing companies, and so they're pretty strict about applying these restrictions to ensure that only companies that are eligible within the sort of spirit of the law and the spirit and letter of the law are able to access them.
Yeah, I think I saw another couple of questions in the chat.
Yeah, so you're talking about the £3 million the calculation of the £3 million. It's not the exercise price. It is almost universally true that a company will agree a valuation of the shares with HMRC before they grant them. It's not mandatory, but you need to have a pretty solid valuation. And the best way to do that is to get your valuation done by generally your accountant and take it to HMRC and say, this is what we think the shares are worth. Do you agree? They will come back and either say, yes, we agree, or no, we don't, and here's why. If they say, yes, we agree, as long as you've not misrepresented anything, they can't later on challenge that and say, actually, we think the shares are worth more. So you, generally speaking, agree the valuation with HMRC before you grant the options. And so the £3 million is based on that valuation multiplied by the number of options issued at the time. And then obviously, if there are multiple tranches, and you do that calculation multiple times and add them up. Charlie's asked a question about 51% of investor majority consent, but not shares. So again, that would qualify as control. So if you had a corporate shareholder that had, only 10% of the shares, but they were, represented 100% or 51% of the voting shares, it would still constitute a controlling corporate shareholder and would disqualify the subsidiary from issuing EMI options. I hope that answers your question, Charlie. Okay.
Okay, so I can take this one. We thought it would be helpful to set out some key questions and considerations for companies who are thinking of setting up share option schemes or other equity incentives. Some of this we've sort of touched on generally already, and it ties into the qualifying criteria for EMI schemes, and in order to be able to benefit from the tax advantages that come alongside that. So thinking about whether any options would be issued to employees or non-employees. Who is it you're trying to incentivize? Are they based in the UK?
Hey Chris, how you doing?
It's typical to set
I was
up
wondering if you could
plans that are designed to incentivize both employees and non-employees. And so where EMI applies and where those employees will benefit from EMI options, there are some additional rules that will apply to their options, but you can use the same plan rules to incentivize directors or consultants. Vesting provisions are an important component of the option award agreement. We've mentioned these already. They're typically broken down into two categories. You can have time-based vesting, where the right to acquire the shares accrues if the individual stays with the business for a certain period of time. 3 to 4 years is quite common. Or you can have performance-based vesting, where they acquire the right to the shares if they hit certain key performance indicators, hit certain targets. But still, they won't be able to exercise the options typically and actually get those shares until a trigger event happens, but they can still vest up until that point. One other thing which is quite common in vesting provisions, if you have time-based vesting, is to incorporate something called a cliff, which is where nothing will vest, for example, for the first year, and then it will start vesting after that. You can also backdate the vesting if it's taken you a while, for example, to set up the scheme, but individuals were informally promised options. Let's say a couple of years ago, you can start that vesting period ticking and that clock ticking at an earlier date than the options granted. Exit-only schemes we've talked about already. This is where those options are only exercisable if an exit trigger event happens in respect to the company, and these are typically defined as share sale, change of control, sale of substantially all of the assets of the company, or an IPO or a listing. And as John mentioned, the option holders will often be compelled to sell their shares in these circumstances. So they acquire the shares for a few seconds, technically, and then essentially just get a cash payment for selling those.
Yeah.
Other few points. Do you want to just grant options over ordinary shares? I mean, if you're looking at EMI options, the shares have to be ordinary, but you can decide whether you want them to be non-voting or voting ordinary shares. Or if EMI is off the table, do you want to create a class of growth shares? Although you can mix growth shares and EMI schemes. I understand. Have a think about what size your option pool should be to incentivize employees and advisors. Getting quite technical, but look into, does the company have existing authorities to grant options over shares within this pool? Are there any additional consents that you need from your shareholders, either under the company's articles or any shareholders agreement? And it's a good idea to start a dialogue with your investors early about this. And typically, if you're creating an option pool, it's often when you're doing an investment round that you'll try and ring fence a certain amount and get the approvals for that when you're doing an investment round, because the investors want to understand the potential dilution that they might experience from that pool.
One point, Lauren, on timing there that we didn't mention in the criteria. It's something of a technical point, but the legislation says that EMI options must be capable of exercise within 10 years of grant. And so you've got to make sure your vesting schedule, generally market practice might be 3 or 4 years for a vesting schedule, but you've got to make sure the shares are fully vested within 10 years. And even if there hasn't been an exit event, you usually have this sort of long stop condition that says 10 years minus 1 day from the date of grant, the options become exercisable. To tick that box and make sure that you qualify for the for EMI status on the options. Otherwise, you can get refused approval for the plan on the basis that theoretically the options might not be exercisable within 10 years. They don't have to be exercised, right? They must be capable of exercise within 10 years.
Yeah, and if that 10 years passes, let's say you don't have that provision that says you can exercise 10 years minus 1 day, option's still valid. You just lose the tax, all of the tax benefits. So that would be bad. Just in terms of
We've
what
got
the
another couple of questions come up in the chat. One here saying, if an executive holds EMI options but dies, can they be effectively retain that character and transfer it into the will or the trust for the future benefit of beneficiaries? The short answer is no. The longer answer is that generally the plan would treat an executive holding EMI options who passed away as a good leaver, meaning that any options that had vested up to that moment would not be invalidated or voided. Any unvested options would typically be lost. And then the fact that the person had passed away means they no longer obviously meet the employment condition. And so that is a disqualifying event. You've got a period of time, I believe 90 days, within which to exercise the options. If that time and you get full benefit of the EMI tax treatment during that period. If that time passes, then what happens is the option becomes an unapproved option from that moment. So effectively, you then have to take evaluation at the moment of death, when the person ceased to qualify for the conditions of EMI, and you split the option kind of split, right? Before that period, it gets tax benefits. You take the valuation at that period, and after that period, it loses its tax favored status. So it's a kind of a hybrid answer, but no, it's not as simple as they can stay in the estate and retain their tax benefits, unfortunately.
Yeah, there's a certain time limit on it. I think for most things it's 90 days. I think in the case of death, because probate takes a while, there's 12 months for the representatives to exercise and get the tax benefits if that's written into the plan, as John says. Yeah. But yeah, there are time limits on it.
There's another question here on growth shares and EIS funded companies. I think we're going to come on to growth shares shortly. EIS funded companies, I mean, you generally see EIS funding rounds with early stage companies, the same types of companies that are likely to be looking at issuing EMI options. They're not mutually incompatible. We have plenty of clients who have both of those things. Obviously, you need to be careful to ensure that you don't end up in a situation where you trip up the requirement for EIS shares not to subordinate other shares. But we can come to that when we get into the pitfalls. But yeah, they're definitely not mutually incompatible. You do see them.
So very quickly on this slide, you'll have your share option plan or share scheme rules, which sets out the rules of the scheme. Annexed to that, each individual option holder will have their own option award agreement, which will set out their personalized vesting schedule and when they can exercise. Board and shareholder resolutions, you'll almost always need the shareholder resolutions to grant authority to grant the options or allot the shares, and probably there are preemption rights that will apply that you'll need to disapply or ask your shareholders to disapply. Getting very technical, there is a provision in the Companies Act in relation to employee share schemes. It's an exemption for the authority to allot, but that's very tightly defined and only applies to schemes that just incentivize employees. And typically for flexibility, you'll want a scheme which is drafted such that you can use it for EMI employee incentives, but also consultant, director, advisor incentives. So that exemption in the Companies Act won't apply. And it's generally a good idea to front load the approvals and get all the approvals up front for the grant of the options, ring fence the pool, and the eventual issue of those shares when they become exercisable. John, do you want to say a word on ITPA elections?
Yes, so the third bullet there is section 431 elections under ITPA, which is a technical point, but one that's worth bearing in mind. it relates to the situation where an option is granted over a share which will be subject to restrictions when it's acquired. What does that mean? So you can exercise your option, you acquire the share, but you're not allowed to sell it without the employer's consent, or you're not allowed to sell it till there's a listing or a trade sale or another exit event. That the default treatment for tax purposes of the acquisition of a restricted share is you're taxed on the restricted value, meaning if the share would be worth £10, but it's only worth £7 because it's got subject to these restrictions, your tax basis is £7. Now that's important because when the restrictions lift, you're taxed on the bit that's not already being taxed, which might be £3, right? But if you've acquired the share under an EMI option, that's definitely what you don't want, right? You want to be taxed. You want to be treated as having acquired it at its full value because you're only paying tax on the market value at the time of grant. So what a 431 election is, it's an election to treat the value of the share as if it was unrestricted. You disregard the restrictions. You treat it as if it was, again, using my dummy example, £10 at the time of acquisition. It has to be signed by the employer and the employee, and it has to be entered into within 14 days of the acquisition of the share. So it's pretty common to see in option plans, both unapproved and EMI option plans, that it is a condition of exercise that the employee must enter into a Section 431 ITPA election with the employer in order to receive the shares. And that's something that exists in our standard form documents, and one to watch out for if you're using documents from elsewhere, because it can result in these kind of unexpected and unpleasant tax charges as restrictions lift if the election has not been put in place.
Yeah.
Okay. It's worth looking at a couple of alternatives. We've touched on the tax benefits of EMI. We spent a bit of time talking about the restrictions that apply. And obviously there are situations where, because you're in an industry which is not permitted, or the company grows to a scale where it's no longer within the £30 million asset limit or the 250 employee limit, EMI is taken off the table. So what other alternatives do you have at that point? Well, maybe with the second one of these first. I'm not doing a good job of following my bullets in there, but CSOP is kind of, I guess, a next best thing in a lot of ways. It has a lower limit, right? It used to be £30,000. It was raised to £60,000 a couple of years ago. And so, yes, significantly lower than 250, but there's still a generous potential to grant options under CSOP to employees there. The tax benefits are pretty similar. You get the key one is you're treating that date of grant as the date of valuation for the purposes of income tax. There is a slight difference in tax in that CSOP options don't automatically qualify for that lower 10% tax rate that EMI options do. They're more likely to be treated as an ordinary capital gains asset and taxed at the 20% rate, which is also rising to 24% following the budget. But nonetheless, CSOP is pretty attractive because it achieves that backdating of valuation. You need to hold CSOP options for at least 3 years. There's no minimum holding period for an EMI option. Again, generally speaking, the longer you hold it, the more accretion in value there is. They tend to be exit only. It generally is something that you would hold for a number of years, but CSOP must not be exercised within 3 years or the tax benefits fall away. So 3 to 10 years. On the plus side, there is no restriction on the balance sheet of a company issuing CSOP. So you can be a £10 billion company and you can go and issue CSOP options. There's no restriction on the number of employees that you can have and still issue those options. And there are less stringent restrictions in terms of the requirements for working time. So they can be quite attractive as a sort of second or fallback option if EMI, no pun intended, but if EMI doesn't work, then CSOP can be something quite attractive. The other thing we're seeing a lot recently, in particular, is the issue of growth shares. Excuse me, my voice is going. Growth shares are economically quite similar to options, in that the intention is to capture the future increase in value of the company, but structurally they're shares. So somebody who holds a growth share is a shareholder. They appear on the cap table. They need to be registered with Companies House. They may or may not have voting rights. Growth shares are generally not voting rights, but they are a shareholder and they have the statutory rights that come with that. But what a growth share is a separate class of shares that is subject to a hurdle. You go through a valuation exercise. You cannot agree it with HMRC, but you go through a valuation with a third-party valuer that produces a value, says your company is worth X. The hurdle value is X plus a little bit more, usually 5 or 10% more. And the growth shares are issued such that, if you have 1% of the 1% of the shares of the company as growth shares, then you participate in any sale proceeds above 1% of any sale proceeds above the hurdle value. Anything below the hurdle value, you get nothing. So economically, it's kind of the same as an option in the sense that if the company doesn't, decreases in value and is worth less than your exercise price, you simply don't exercise your option, you get nothing. But as soon as you're above that exercise price, or the analog in growth shares is a hurdle, as soon as you're above that, you participate pro rata with other shareholders. Typically, as I said, they're not voting shares. Typically, they're not eligible for dividends. They can have either of those features. It has valuation implications that are generally not attractive. The idea usually is to emulate the economics of options. So typically, you don't have those features turned on for growth shares. We're seeing that a lot more now as it provides a lot more flexibility. Right? There's no need to meet or to prove that you meet requirements around gross assets or a number of employees. There's no restriction on issue of growth shares out of a company that may be controlled by another company. And so I think that the structure has kind of developed around those. They're a lot more popular, even over the last sort of 2 or 3 years, I think, than they were before that. Again, quite an attractive option. There's no exercise, right? There's a grant of growth shares, and then you just hold them and then you sell them. So there cannot be another moment of income tax at any time during that holding period. Again, subject to making that Section 431 election when they're granted, if there are any restrictions there. And when they're sold, all of the increase in value should be taxed as capital gains rather than as ordinary income. So again, you're kind of back into that scenario that we're all aiming for with EMI options. There's nothing, and they're not mutually exclusive, right? You can have an EMI plan in place and a CSOP plan in place to top people up if you've got employees who are already at the £250,000 threshold, for example. You can grant growth shares to employees who wouldn't otherwise qualify because they're part-time, or there's a whole bunch of reasons you might want to do it. But the point is, you sometimes see these hybrid solutions where you have EMI and CSOP and growth shares, or two of the three all kind of cohabiting within one company.
Yep. Pitfalls, always an important thing to try and learn from the mistakes of others. So we've set out 5 main ones in relation to EMI schemes that we think are particularly important to focus on and be aware of. The first, a very sort of elementary one, is missing HMRC filing deadlines. So if you set up an EMI share option plan, you need to register the scheme itself with HMRC, and you also need to tell them every time you grant new options under that scheme, and there are annual returns that you need to make. So the deadlines, they changed recently for telling HMRC about the grant of options on or after the 6th of April this year. So any options granted on or after the 6th of April, you need to tell HMRC about them by the 6th of July next year. So 6th of July following the end of the tax year that the grant was made in. This replaced, I think it was 92 days that you had before to tell HMRC of the grant. So you've got a lot more time to tell them. But with that, I suppose, increases the risk of forgetting. So it's very important to keep track of those deadlines, make sure that you don't miss them, because if you don't tell HMRC about the grant in time by the deadline, then you could disqualify the tax benefits applying to that option. So it's very bad. You can apply to HMRC late and request forgiveness, but I think they're pretty strict with that, and you'll need a really good excuse for why you missed the filing deadline. If you miss an annual return, there are financial penalties for the company. I don't think it has an impact on the tax benefits for the options themselves, but there are financial penalties on the company. So diarize those filing deadlines. The next point, more of a practical one. So it's not a legal requirement to agree a market value valuation with HMRC for the grant of EMI options, but it is very, very strongly advised to do so, because as John's mentioned, a lot of the tax benefits flow from the fact that at the time of grant of the option, the exercise price was at least the market value of those shares at the time. So you don't really want to get into an argument with HMRC 5-6 years down the line when there's an exit event going on in relation to the company about what the market value was at the time of grant. Much better to agree it with them at the outset. I think their turnaround times are, like, they're not quick, but it's maybe 6 weeks or so at the moment it's taking them to agree these valuations. But then you have it in writing, you have a letter from them, and those are valid for 90 days, I think, for the grant of options. So it's very strongly advised to get a valuation and agree it with HMRC. The next thing is to be very aware of disqualifying events that will nix the tax benefits of those EMI options that you have. These will include changes of control of the company granting the options that mean that that company is no longer independent and no longer meets that independence test. If the individual employee leaves the company, that's also a disqualifying event for them. But there are a number of other things as well, such as, yeah, if the trading business changes to something that's an excluded activity, that's a disqualifying event. For changes of control, there is a mechanism built into the legislation which allows you to swap options from a company that's being acquired, but there's quite strict criteria and you have to follow it very carefully. So do seek legal advice if there's an exit event coming up.
That's a really important one, actually. You know, the possibility to exchange options. If we have a scenario where you're being granted options with a share value of £1, and then the company's acquired for £10 a share 12 months down the line, 24 months down the line, what you don't want to do is lose those options and get new options, because you're going to have to set it at the market value at the new valuation, which imposes obviously a greater tax burden or less value to the employees, and also subjects them to the financial limits on this much higher valuation. So you really want to make sure you've got a good exchange of options that preserves the financial economic conditions of the original options, and that's what the legislation is intended to do. But as Lauren says, it's really important to get the steps right, not to fall foul of, you know, a simple mistake that could be costly and cause the options to lose their EMI status and have to be reissued or lose it altogether.
Yeah, and the possibility to exchange the options, it's often written into the scheme rules, so to focus people's minds on that. If a disqualifying event happens and the options are not exercised within 90 days, if that's a possibility under the rules, then income tax will be due on the difference between the market value at the date of the disqualifying event and the market value at exercise. Other things, use of discretion to vary terms of options. So sometimes, in particular in blended plans where you can use them to incentivize employees and non-employees, the board of directors of the company sometimes has discretion to change certain things, accelerate the vesting, waive performance conditions, decide when the options can be exercised outside of the existing triggers that are written into the plan rules. HMRC really does not like this. If it changes a fundamental term of the option, and what HMRC deems a fundamental term is the number of shares, the price, or when the option might be exercised. So it's not acceptable for EMI options, for an option to become exercisable at the complete discretion of the board. What you can do, so long as it's sufficiently clear as drafted in the plan rules, is you can use discretion to accelerate vesting or vary or waive performance-related conditions, so long as the effect of that is not to allow the option to be exercised any earlier than it would otherwise be, because that can disqualify the EMI tax benefits. So if you're thinking of, if you have this provision where the board can use discretion and you want to use it in relation to EMI options, be very careful, do seek legal advice. You can sometimes ask HMRC for an opinion as to whether you can do that in the circumstances. And the final point is a very practical one, just about ongoing monitoring and compliance. So we've mentioned filing deadlines, diarising those, but also try and have a person within the organisation who's responsible for monitoring the scheme, the grants, who's vested when, and just keeping track of everything, because it's very important. And when it comes to, if the company's planning a sale that would trigger the exercise of these options, it's great if you already know whose options have vested and how much they're going to be entitled to exercise. Final slide.
Perhaps if I take this one, and we just thought it was worth adding in a couple of thoughts on pitfalls in terms of growth shares. They don't have a lot of the performance requirements that exist for EMI options, but they do come with their own downsides. So there is no mechanism to agree a valuation with HMRC, which means with an EMI option, you get your valuation done, you take it to HMRC, they sign off on it, and you're gold. That's kind of bulletproof. There's not really any way that they can argue with it unless they take the position that you've misrepresented something and deliberately undervalued your company or misled them in some way. Because there's no way that they just won't accept a request to agree a valuation for growth shares, you need to be very, very confident that your valuation is robust. It's all self-assessed. So when the options are granted, the employee files their self-assessment tax return. They say they've got no income because from the growth share issue, because the growth shares were worth a penny each and they paid a penny each for them, whatever. If they get an inquiry into that tax return, you need to be able to point to a piece of paper that very convincingly sets the valuation or supports the valuation of a penny a share. Otherwise, those employees can find themselves in a pretty nasty position with potentially uncapped tax liability if HMRC takes the view those shares are worth a lot more than that. Linked to that, you need this sort of two-stage valuation. So the way that they work, remember, is you determine a hurdle value. The growth shares only participate above the hurdle value. So if we say that the company is worth £1 million today, and we're going to grant you shares worth 1% of the company, then in principle that means that if the company sells for £2 million, you get 1% of that £1 million delta. HMRC will say that if you set the hurdle at exactly the market value of the company, HMRC is likely to take the view, well, there's some expectation value in those shares, right? Yes, if the company was liquidated for exactly £1 million, you get nothing, but as soon as it gets £1 more value, you're starting to participate. So in order to get to a position where you can say those shares are only worth their nominal penny a share value, or 0.001 pence a share, whatever you want to get it to, you generally need to set that value a little bit higher. So the company might be worth £1 million, but you set your hurdle at 1.05 or 1.1 million. So you've got this sort of two-step process to get there, and that needs to be done by somebody who really understands growth shares and is qualified to do that. Generally speaking, corporate accountants that deal with early stage companies will be quite used to this, but it's quite important to make sure you get that one right. And I've talked about the points if you don't have a solid valuation. The last point there kind of touches on one of the points that was raised in the chat, which is about the interaction with SEIS and EIS shares. We've got a whole separate session on SEIS and EIS. I want to get to the ins and outs of those. But what these are in brief is a tax favored equity construct for individual UK resident individual investors. Very tax favored, right? In the case of SEIS, somebody puts in £50,000 into your company, they can claim £25,000, 50% of the value as a rebate against their income tax for that year. So it is potentially very attractive. One of the conditions among many for SEIS and EIS is that the shares must not have a liquidation preference over other shares. They're not allowed to be preferred. So you can't, that's what I said earlier in the call about subordinating other shares. You can't have a situation where the SEIS shares have to get paid out, I don't know, 100 cents on the dollar before anyone else participates, before the ordinary shares participate. And that's well understood. Typically, SEIS and EIS shares are granted as just ordinary equity. They participate the same with the founder shares and other ordinary shareholders. The sting here is that you've got a share class, a growth share class, that does not participate below the hurdle value. So you need to be very careful about the way that's worded in the Articles of Association to make sure that it doesn't get zero, right? It technically gets £1 or the first 0.0001% of the liquidation proceeds or the sale proceeds, so that it isn't technically subordinated, right? It just participates at a much smaller percentage, in a much smaller way, insignificant way, but it still has a technical right to something alongside the SEIS and EIS equity. Otherwise, those shares can be invalidated, and that's very bad from the tax perspective of the investors, and from an investor relations perspective, it's not a good look. So one to be very careful of where you've got an SEIS or EIS shareholder, one or more SEIS or EIS shareholders in the company, and are looking to raise or to issue growth shares to employees. And that was the last one we had on that. We've gone a little bit over time. I've got some more time if anyone has any further questions. I think we've answered everything in the chat, but if anyone else has anything, please yell out.
I think so. Thanks, Anthony. Thanks, Michelle. Yeah, we will share a copy of the slides. I'm pretty sure those will go around in the recording as well, if you want to watch it back.
John, thank you very much. Really, really useful. Quick one on CSOP. Can you use that if you're professional services?
That's a very good question. There are definitely lighter restrictions on the permitted activities of companies issuing CSOP shares. I don't believe there's a specific restriction for professional services companies, but let me check that one and come back to you offline, David.
Thank you very much. I tried Googling it during the thing, but couldn't find an answer.
No problem. I should be able to get an answer for you very quickly.
Thank you very much. It's really useful.
Okay, well, look, anyone else has any other questions, you're more than welcome to reach out either to Lauren or to me by email. We're more than happy to answer those, and just wanted to say a big thanks for taking the time to join us today.
Yeah, thank you.
All right, thanks everyone.